Welcome to the Australian Household Finance Show, where we will explore topics that will improve your financial knowledge and help you understand what actions you might take to improve your financial situation. This show is for educational purposes only and is not intended as personal financial advice. What you should do or should not do depends highly on your personal situation. Don't take financial advice from the internet. Hello listeners, my name's Matt Boxer. I'm the owner and director of GPA Financial Planning, and today we're going to take on a topic that some people are very passionate about. Most likely, you've already got an opinion on which one's better as an investment, whether it's better to invest in property or shares. Now, I'm probably not going to change your mind on that, and in reality, I'm not even trying to. Which one is better will depend on your situation, but what I'll be able to do is go through, well, which situations do shares work well in, and which situations do property work well in as an investment option, so that when you're looking at your situation, you can make an informed decision. So, let's get started and define what we're talking about when we discuss investing. Because a lot of people make a very big mistake in considering this topic by confusing investing with speculating. They will say things to me along the lines of, well, my preference is property because, I've held one for 20 years and it went up in value quite a lot, and therefore that was a really good experience. But when I tried shares, I kind of dabbled in it. I kind of bought a few little bits of shares for, a couple of $1,000s on a tip that a mate gave me. And I lost all my money in that. There's a key difference between what you were doing in those two situations. With the property, you were investing. You were looking at what type of rent and what type of income it would get over a long period of time, and whether that income would increase in value, or whether the rents would likely increase with the health of the economy and the wage growth that Australia has experienced, would go up over 20 years, and therefore the price of the property would go up over 20 years, and that is what investing is. What the situation I just gave then about shares, that was speculating. Putting a couple of $1,000s on a tip that you've got from a mate, or one particular share, thinking that, well, maybe it'll go up in value in the next couple of months or years, for no other reason that shares go up and down, and maybe I've just got in at the right time. That's not investing. That's speculating. A common definition of investing is the use of money productively so that regular income is obtained. You'd notice there that the definition is not that the asset I buy will be worth a lot more in the future. An asset going up in value is as a result, generally speaking, of the increase in the income obtained. So often when you look at investing, you've got to look at, well, what is the income? Because that's really what I'm purchasing when I'm investing. What I'm either purchasing the rent, or I'm purchasing the dividends, or I'm purchasing the interest from a term deposit. That's what I'm getting for giving up my capital. So it's important you understand that going into what we're going to discuss today. The next thing I want to discuss is what risk really means. Now, often when we talk about risk, you'll hear things along the lines of cash is low risk, property is sometimes called medium or high risk, and shares are obviously high risk. But that's very one-dimensional, because that is looking at one type of risk only. There are many types of risk, and at the end of the day, when you're investing, you've got to decide which risk you would prefer to take on. No matter where you put your money, no matter where you invest, there is some type of risk. It might not be market risk. It might not be the risk that tomorrow you wake up and your asset is worth less than what you paid for it. But there will be risk nonetheless. So some of the risks that you need to consider when you're investing. And one of the big I'll start with the big one that often people don't really think about all that much. And that's longevity risk. What's the risk that you're not going to have enough money throughout your lifetime, particularly in retirement? What happens if your money runs out before you do? What's the chances of that happening? Unfortunately, in Australia, that's fairly common, that people end up having to rely on the age pension. 60% of Queenslanders, or at least last time I saw statistics about it, it was 60% of Queenslanders retire with the age pension as their primary source of income. Clearly, they did not build and grow enough wealth throughout their life to support what they need in retirement. So you could put all your money in term deposits and cash, things that have no market risk, and market risk is the ups and downs in the short term. You're not going to wake up and your term deposit is worth a hell of a lot less than what it was the day before, but you have high longevity risk. You have a high risk or a higher risk that you're not going to experience enough growth in your assets to meet your retirement needs. Other risks that you've got to consider is geographical risk. What if, or sometimes called diversifiable risk or non-systemic risk, all your assets in one industry, one share, one property, one country, one city, exposes you to a level of risk that you might not need to take on. If all your assets are in one town that's a one industry town, that's a mining town, and that mine shuts down, what happens to your assets? If all your assets are just in ExxonMobil shares and a company like Tesla really manages to get a foothold converting the automobile industry from petrol to electric, what happens to your assets? What happens to your retirement? So diversification is a good way to manage non-systemic risk. Other risks you need to be aware of are things like inflation. What happens if the cost of everything, the goods and services that you buy, go up in price year by year, faster and faster, and your income from your investments are not keeping up with it? Timing and sequencing risk is what happens if just at the point before your retirement or just after retirement there's a major market correction or crash in the asset sector that you own, so in shares or property. What happens then? What happens if the whole financial system collapses? So all these risks are things that you have to consider when you're considering investments. You have to understand them and consider them. By just saying that shares are high risk and term deposits are low risk, that is very one-dimensional and very misleading in what can go wrong in your financial life. So with that out of the way, let's have a bit of a chat about property to start with, and what actually drives property prices up, because understanding what is going to drive your asset value higher, or more importantly, what is going to drive the income that that asset creates higher, because that is effectively what's going to drive the price higher. If the income it creates goes up, then the price will go up. Term deposits provide the same income. Year on year, you have $1 million invested. The income you get is a fixed interest rate, doesn't go up. Therefore, at the end of the term, that $1 million is still $1 million. Whereas property, you will hope that over time you will be able to increase rent. So as rent increases, so does the price you can demand to sell that property. Now, what causes rent to increase in a particular city or a particular country or town? Well, typically it's the supply versus demand of property. It's the idea that if you've got more people coming into the town with more money, that there is going to be a larger demand and a smaller or a shorter supply, or the same supply. Therefore, you can charge higher rents than you were able to last year. And beyond that, there's also an inclusion in the price for an expected future rise in income. If the expectation is that rents will go up and continue to go up, which there's no reason why they shouldn't over time with inflation, that can be factored into the price of the property. Other things that need to be considered is what's happening on the supply side. Are there new houses being built? The cost of ownership will obviously be a factor because you've got rent, but you've also got expenses that you've got to cover when you own a property. So really you're looking at net income and the change in that. Also population growth. Obviously, if more people are coming into a particular area, then that will cause an increase in demand. And also, as with every investment, there comes a level of a human emotion when it comes to what someone should pay. If people are scared of investing at the moment, for whatever reason, they're not going to pay the same amount for a level of income than they would have if they're feeling very greedy about it all, if they're feeling very positive that there's nothing that can really go wrong and it's all bulletproof. They will pay a lot more for a certain level of income if the market is greedy at the time rather than fearful. Now let's talk about what drives shares. Same thing, supply and demand. Everything in investing comes down, everything in pricing comes down to supply and demand at the end of the day. So when it comes to what affects supply and demand in shares, there's a few different things that are going on. Firstly, the income comes in a different form. It comes in dividends or distributed profits from the company. So one step back to basics. When you're owning a share, what you're doing is you're owning a percentage of a business and rights to the profit of that business. Now, that business might not send all its profits to shareholders. It might come and keep some of the profit and reinvest and buy more stock and open more stores. But generally speaking, the return for an equity investor is their dividends, their payment that happens twice a year from the company as a distribution of profit. So what affects share prices is the dividends currently being received as well as expected future dividends. If it's expected that a company is growing at a fast rate and growing their profits at a fast rate, you might reasonably expect to have to pay more to purchase shares in that company. There's obviously cost of ownership as well in terms of buying and selling, but it's significantly less than property. Obviously, you've got transaction costs in terms of maybe a broker or managed fund, but you don't have rates, a real estate agent, lapses, or times where there's no tenant in the property. As I've already mentioned, company profit and growth feeds into this, and also fear and greed, but probably more so with shares and property. People tend to be a little bit more fearful and can get a little bit more greedy when it comes to shares just because of the nature of what they are. The fact that there's no tangible asset. To give you an example of that, during the GFC, I had people come to me for the first time and their super had gone down by 20% or 30% because they're in a balanced investment, and their investment property had gone down by 20 or 30% because of where they were, and Northern Gold Coast went down some properties there by a significant margin. And then you discuss what they wanted to do and what they were thinking, and their response was, well, I think I should sell all my shares inside my super because they've just gone down in value. But my investment property, I think I should just leave that and I'm not going to sell it for 20 grand less than I purchased it for. I'll just wait until it recovers. Almost the identical same thing happened with both assets, but their reaction was very different. And that's common in that property is much more tangible. People understand it a little bit more. They're a little bit more familiar with it, so that their reaction tends to be less fearful when things go down in the market cycle. Now, I briefly mentioned on reinvested profit, but another thing that drives shares up that doesn't always happen with property is a reinvestment of profit. So when Commonwealth Bank make a profit for the year, they don't send all that profit to shareholders. Some of that profit they keep to develop new technology, new apps, new products, new services, open up new branches, spend some money now to improve profit later or profitability later. Now, you can do that with property. Obviously, you can take some of the revenue you get from your property and invest in upgrading the patio or adding air conditioning or something like that might mean that you can charge higher rates of rent. But normally people don't automatically include an amount to do that within their calculations. Normally they don't even include an amount to repaint their house every 5 years and replace the hot water system. But that's a bit off topic. So shares have the added bonus that they've got the reinvested profit often driving up income growth over time as well. So next, let's go to what the numbers tell us. When we're comparing these two assets, what has actually happened in Australia over the last 20 odd years? So this is the real rate of return of these investments in terms of their growth. This is from Russell's Investments 2016 long-term investing report. You can find that on the ASX website. It's a decent read. Now, they obviously take into account some assumptions with residential investment property, because it's kind of hard to get a number for residential investment property because people will spend money on renovations and there'll be buildings and there'll be subdivisions and housing knockdowns. There's a lot of money that gets poured into property. So if you just took the headline figure on what was the median house price 20 years ago to what it is today, you're not really taking into account that the houses on the land have been improved and money has been spent over time in doing that. And I believe Russell's investment report takes that into account. I'm not sure the exact details and the technicalities of how they do it, but I'm sure it's fairly sophisticated, and I'm sure they're not trying to advocate for property given that it's on the ASX website and they're commissioned to do this report by the ASX. So regardless of that, they still say that over the last 20 years, property has significantly outperformed other asset classes. Shares going at 8.7%, property going at 10.5%. Listed property, which is typically more commercial in nature, so shopping centres, things like that, going at 7.7%, and bonds, which is another topic altogether, going at 6.8%. So judging on that, you could very easily make an argument that property is better than shares based on performance. However, there is a disclaimer that you would have heard on a lot of ads. Past performance is not a reliable indicator of future performance. Have you heard that before? What that's basically saying is that just because something has gone at 10.5% over the last 20 years does not necessarily mean that it will go at 10.5% over the next 20 years. Just because something performed very well last year, just because shares went up by 20% last year, doesn't mean that they'll go up by 20% next year. That is not how investments work. So what I'd encourage you to do is look at what the numbers don't tell you. Look beyond the numbers. Let's talk about the other benefits and other issues that you have with shares and property. So let's start with property. Some big benefits with property, and one of the biggest in the current Australian tax environment, is that you can highly gear property if you wish to. What that means is that you can go to a bank and borrow 90% of the value of the property to purchase it. You only need a 10% deposit. You obviously can't do that with shares. You can do it with about a 30% deposit, although I think you'd be crazy to do that. You'd want at least 50% with the use of a margin loan, which is how you gear into shares typically. There are other ways of doing it, but in a like-for-like comparison with going to the bank and buying a property, you'd be going to the bank and asking for a margin loan. The other benefit with property is that you're forced to be long-term. Nobody goes out there and day trades property. It's too expensive with real estate costs and stamp duty. You've got 20 grand to get in and you've got 20 grand to get out. So because of that, you tend to hold it for 10, 20, 30 years. You're forced to be long-term in your horizon. This, however, is obviously a bit of a double-edged sword, but I'll get to that a bit later on. The other benefit of property is that it often forces people to save, because the bank has an interest payment that somebody needs to make, and they're not exactly going to turn around and go, oh, this month, I want to spend a bit more money on living, so I'm just not going to pay the bank back their interest on the loan I borrowed from them to buy the property. Just doesn't happen. So it forces people to have a bill every month that they need to pay towards in order to have this asset. Again, a double-edged sword, but that can be a benefit for people who aren't very disciplined in their savings. It also has typically a more positive mindset attached to it. As I mentioned before, when the values of property goes down, people just tend to go, well, I can't sell for that because I bought it for 30 grand higher or 50 grand higher. So they just hold on to it and wait for it to go back up. It might be costing them 10 grand a year to hold on to it, but they'd prefer to hold on to it for 3 years and get their money back than sell it and lose 30 grand, despite the fact that at the end of the day, the costs were still the same because it cost them 30 grand a year to hold on to it. So people just have a different mindset when it comes to property. Their investing mindset is much more productive. The other thing with property is you've got a bit more control and you can develop the property. Now, typically, when I talk about property, I'm not talking about property development. That's a different type of way of creating wealth that most people don't do when they're talking about property. Most of the time when we're talking about property, we're talking about buying an existing house, holding it for a period of time, and selling it for hopefully more than what you paid for it. Development is a little bit more speculative. Might be subdividing a block, might be putting up some apartments or knocking down the existing house and doing some major renovations. However, with any property, you have a little bit more control. You can choose whether you want to redo the kitchen or whether you want to repaint the outside of the house or which tenants you allow to rent your property. You have some control. Whereas with shares, if you're an investor in Woolworths, you don't get to say whether they open up Masters to compete with Bunnings. It's not really your call. So let's move on to some of the other benefits in shares that you should be aware of. Shares are obviously much easier to diversify. A lot of people can only afford one or two properties, which means all their eggs are in one city, in one asset, in one place. So if that one place has problems, if that one country has problems, then you've got a bit of trouble. So for example, Australia has gone 30 years without a recession. If all your investments are in Australia, what happens if the next 20 years in the Australian economy are like the last 30 years in the Japanese economy, where things have just gone from bad to worse, asset prices have dropped, share prices are down, and things are still struggling to get out of the doldrums? What happens if that happens to the Australian economy? And there's nothing that guarantees that it won't. With shares, you could at least have some exposure internationally. You can at least have some of your shares invested in things like Google or Apple or Bank of America or something like that, something outside of Australia, so that even if Australia struggled, perhaps those companies won't. So perhaps part of your portfolio will continue to perform well. Shares are also a little bit more tax effective. The reason for that is that the income you get from shares has already had some of the tax paid on it. This is called dividend imputation or franking. So when a company makes a profit, they pay company tax. When they give that profit to you, it has a franking credit attached, pretty much telling the ATO that, hey, this money here has already gone through the tax system, so don't tax it the same as if it was just earned income, as if it was just rent, or as if it was just money from your employer. Tax it effectively less. So taking into account franking and dividend imputation is often important when you're looking at return on investment. Shares are also liquid, which, like I mentioned with property, is a double-edged sword. Liquidity is basically the idea that you can sell it quickly and easily without much cost. The advantage of that, if your situation changes or you need money, you can actually access your money quickly. Whereas with property, for example, it might take you a month to find a buyer, a month to settle, and it will cost you tens of thousands of dollars to do that. Now let's talk about some other issues. Property has high holding costs. So you've got rates, insurances, real estate agent fees, maintenance, things like that that you need to pay, that you need to take off the income that you're earning when you're calculating return on investment. As already mentioned, it's hard to diversify and it's also pretty illiquid. Shares have their own set of issues. They tend to be more volatile. In any 1 year, shares can go in massive swings. 1 in every 5 years, we expect that the share prices will drop temporarily by 20 odd %. Often every year, there's at least a 5% drop temporarily before they continue doing what they normally do. The next major disadvantage is about the lack of control. So this is obviously the opposite to what we talked about with property, where shares, you don't get to say how money is spent within the company. They've got a board of directors which is responsible for representing your interests and is responsible for appointing the CEO, who then determines where the money is spent. But certainly you as an individual have a lot less control. Lastly, shares aren't tangible. You can go and admire your investment or look at your investment with property. With shares, I guess you can drive past the ATM of the Commonwealth Bank and think that you own a little bit of that, but it's not really the same kind of thing. Next, I want to go through why you shouldn't just look at past performance when making an investment decision. Maybe there's been some big trends over the last 30 years that aren't going to repeat themselves again. Maybe that's impacted the value and the growth of some of these assets. And if you assume that just because something has happened in the last 20 years, it's going to happen again, maybe you're making a faulty assumption there. So I'm going to, for those who are watching this on YouTube, you'll see this obviously in the video. For those listening on the podcast, then you can download this from the show notes that are on the description of the podcast. So the first thing I want to show you is interest rates. So interest rates since 1985 have been on a pretty clear path downwards. You might remember, if you're old enough, interest rates on home loans being up to 20 odd %. If you're not old enough, you might remember your parents reminiscing about interest rates on home loans at 20 odd %. And over time, those interest rates have, not in a straight line, but have gone down over time. So as interest rates have gone down, what effect has that had on people's ability to borrow money? Well, whether it's causal or just a correlation, Australians have a lot more debt now than they did 30 years ago. 30 years ago, in the 1990s, or prior to the 1990s, the amount of debt people had as a percentage of their income was about 45%. So if you earned $10,000 a year, you might have had a total debt of $4,500. That was what the average income versus debt level looked like. Now that percentage is up over 150%. So obviously with inflation, people earn more. So maybe these days you're earning $60,000. The average debt that somebody earning $60,000 would have would be 150% of $60,000. So quite a significant amount more. Now, as lower interest rates has allowed people to take on more debt, taking on more debt has meant there's been a greater demand for property. People are able to pay more, so they do, and property prices, as in relation to income, have also risen. So previously, house prices to income levels were about 3 times. So if you earned $10,000, the house price was $30,000. Now it's up to 5 times. So if you earn $60,000, the house price is $300,000. So the ratio of house price to income has changed because, or maybe because, household debt to income ratios have increased, because, or maybe because, interest rates have come down. Now, this isn't me saying this. This is coming from the Reserve Bank in a recent research white paper that they've put out, trying to determine the causes of the rise in house prices over the last 20 or 30 years, or the unusual rise in house prices in the last 20 to 30 years. They also pointed to some other factors that have contributed to this. They pointed to the idea that since the 60s, where there used to be about 3.5 people per household, to today, where there's only just over 2.5 people per household. So if the population was the same, and we had less people living in each house, therefore we'd need more houses. So obviously, just looking at population growth doesn't give you the whole picture if for each 10 head of population we need more houses to cover that off as a country. So that's also contributed on the demand side. And they kind of put all these factors together and say, well, that means that over the past several years, demand has outstripped supply, or the increase in supply, dwelling completions, for a number of years. And that's what they point towards in terms of affecting property prices. They also look at the idea that we've had population growth increasing since the 1990s. However, we live in a world today that is probably getting a little bit more maybe anti-immigrant. Certainly there's a sector of the political spectrum that are calling for a reduction in immigration. So if there are less immigrants coming in, if less people are immigrating to Australia, we need less houses. If the demand or the supply is the same but the demand drops off because we have less immigrants, what does that do to the price? So the point of all that is, yes, these numbers are very positive, very strong for property, and very strong for bonds as well, with interest rates coming down over a 30-year trend. But interest rates can't go from 2% to negative 14%. There's only really one direction they can go from here. Well, I guess two. They could either go up or stay very low for a long period of time. But regardless, what do either of those two options mean for your investment portfolio over the next 20 or 30 years? It will affect both property and shares. So that is something that you should really be thinking about in a more long-term sense if you're an investor rather than a speculator. So now I want to talk about situations where property is likely more appropriate versus situations where a share portfolio is likely more appropriate. So a situation where a property would tend to work well in relation to shares is where you might not have a home loan, or you might have a very low home loan and not expecting to take on any large future debt. So obviously if you're just starting out, one of the issues I commonly see is that people will go, well, I've got good cash flow at the moment, got a good job, double income, no kids, don't have a mortgage, haven't bought my first house, but I'll buy a rental property because generally their parents say that's a good idea. So they go ahead and do that, and a lot of their cash flow then starts going towards that new mortgage that they've got, but then they decide to get married, buy a house and start a family, but they can't really afford the mortgage on their own house because it's going towards a rental property, and they certainly can't afford to drop one income. So typically it's people who've kind of got through that cash flow hump of starting a family, dropping an income, and have paid down a significant amount of their own home loan. Next is they have high savings capacity. So that is, they can afford to be putting $20,000 a year into a investment. They're not going to need that 20 grand a year for something else prior to retirement. Next, they might have liquidity elsewhere. So they might have some cash reserves or other investments that if they need money quickly, they can access that money quickly. And secondly, they prefer non-systemic risk over market risk. So they don't mind having some volatility. They prefer to have the risk that, you know, they've got all their assets in a couple of properties maybe. So they don't have a great level of diversification, but they'd prefer to have that than have a higher volatility that might be related to shares. Where shares are more appropriate, it tends to be for investors that have a less emotional outlook on investing, that are more looking at, well, what do the facts tell me are the right situations to buy or sell? They're not going to panic sell if the share market goes down. Typically, they're a little bit more time poor. Property can obviously take a lot of time to manage and to research and to work out, okay, well, this suburb, is it going up, and what type of tenants would I be getting and what type of rent should I be charging? And they're more comfortable with market risk than, say, property investors. They're more comfortable with the roller coaster of returns year by year. But in reality, both investment strategies can be successful. I have seen people become financially independent investing in property, investing in shares, even investing in things like bonds and term deposits. Because what really makes a investment strategy successful are these four things. How you manage the risk, whether you understand the risks to begin with, and then how you manage those risks. What's your actual strategy? So rather than just have an investment purchase, do you have a strategy on how that wealth is going to build, what you expect it to be year by year, and how you're going to exit your position and how that's going to actually fund your retirement? Are you actually going to be able to regularly save money? Are you going to be able to actually add to your superannuation or share portfolio or property portfolio over time, and how is that going to look? And the other thing is time. People who start earlier in life have a much, much, much easier time of it than people who start later. Most people who are looking at these things in their 20s, in their 30s, and even in their early 40s, probably either of the strategies would likely, not always, if they don't manage the risk, but likely work out with a decent result because they've started early enough. But if you're starting in your 50s or 60s, it's a different story. Probably neither of the strategies would work well enough to fund your retirement. So starting early is absolutely key. So I hope that's summarized how shares relate to property, things to consider, different risks to look at. If you have any further questions, feel free to shoot me an email. It's matt@GPA Financial Planning. Or if you have any suggestions for future topics that you'd like me to cover, then I'm happy to receive suggestions. Other than that, thanks for listening, and don't forget to subscribe. Welcome to the Australian Household